What's going on, everybody? Welcome to the Gray Report. I am your host, Spencer Gray. We've got Matt Bosnagel here, Director of Communications and Marketing. If you're a multifamily investor, you're trying to get into the multifamily investing space, or you're already in the space, you're working in the industry, the Gray Report has been designed for you to help you stay on top of everything that's going on in the multifamily industry, real estate, and the economy. Every week on the Gray Report, we are breaking down and providing analysis for the latest research reports, data, articles, everything that's coming out. I'm trying to parse, what's real, what's not real, the best way to look at it so we can see the forest through the trees and make some good decisions. A lot's going on. We had some great reports, Marcus and Millichap, JLL, NAR. Matt's going to break it all down for us. All right. Again, on the Gray Report, Matt, again, thanks for being here. We're all prepping for some major snow in the Midwest right now. I think we're looking at, 12 inches or so tomorrow. But that's not going to stop us getting the Gray Report out to multifamily investors and folks in the multifamily industry. Gray Report newsletter is going to go out tomorrow morning, every Thursday at 8:30. Rain. It's like the post office. That's right. Right. I don't think we've gone a week without the newsletter or a newsletter recap video, really since we started doing it. Yeah. So it is like clockwork, trying to provide the right information and intelligence for all the folks in the industry, trying to understand what is that next right move. But anything new with you, Matt, or what's going on?
Nothing really new other than prepping for the snow and maybe driving around with a snow shovel just in case.
That'd be fun.
We've got a lot of good things about the broader economy that came across this week. But really, I'm curious if you would like to share a little bit about what's been happening at Gray Capital. I think that there's been a lot of exciting things going on, and really, I got the best person to talk to about it. So.
Well, yeah, and we were talking a little bit earlier about the pipeline, and obviously we're getting ready to launch our first fund, the Gray Fund, here in the next really 2 weeks or so. So we're really excited about that. A lot of work and we've been working on it now for the last 4 to 6 months, really kind of putting the plans together. And you can have the right investment vehicle all day long, but if you don't have the deals, you don't have the volume of deal flow, you don't have the right deals, it's kind of all for naught. Right now, what I'm most excited about, really take the Gray Fund out of it, but what I'm really excited about is the pipeline we're seeing right now, the types of deals, and we think that we're actually going to be able to get under contract some really great opportunities. The market has changed from a couple of years ago. We've shifted our strategy, not in a material way that we're doing things too differently, but we're just looking at deals in a different fashion than we did, just because there's this huge gap between, average lease rents or the effective rent at a property right now and then what the new market is. But at the same time, we don't want to just say, there's going to be all this really strong organic, rent growth. Even though market rents have already moved, we know we can get over to that point eventually. But adding in a tactical, value add renovation plan that we're not going to get bogged down with crazy material costs, but something that's going to push the property forward. So if you don't get that really strong organic rent growth, you're still forcing appreciation and taking the property to the next level. And so what we're seeing a lot right now, we're looking at a lot of 90s vintage properties, kind of mid 90s that were built pretty well. There's not a huge difference physically from when they were built in the mid 90s and some of the apartments that have been built in the last 10 years or so, besides the interiors. The interiors are mostly classic, so they're kind of at this right stage in their life cycle of they're still in good condition. It's not like the deals we've seen in the 60s and 70s. But the interiors just need to be upgraded to really compete. So we're really excited about those opportunities. A lot of good deals. We're looking at it in Indianapolis, a handful of other markets. I think right now we've got about 16 deals in the pipeline.
Wow.
We've toured a little over 1,000 units in the past week, another couple hundred today.
Yeah.
So, out of the, I think total deal pipeline, we're like 600 million. So, if we can, get a handful of those, we'll be happy to get rolling.
Now, it's a little ahead of us, but what is your perception of how tight maybe the market is going to be this year?
we will really see once we start getting into the bidding process.
Yeah.
So like we're touring a lot of assets. The bids are due in the next week or so. We know there's a few properties that are going to be very incredibly competitive.
Yeah.
We think that they're great opportunities, but we just know that there could be an investor who goes to a place where we can't go in terms of their price and their return thresholds. I think there's some other assets that we are going to be the best buyer for, and we're going to be more nimble, and we are going to be more competitive than others. So I think we'll see over the next couple of weeks the amount of volume that's out there right now, and this is really coming off of NMHC that was 2 weeks ago now. Kind of waiting for that event in Orlando to really start to launch a lot of these projects. Most of the brokers have been getting ready for NMHC, getting the deals ready, but getting ready for that meeting to have these conversations.
Yeah.
And then so last week, Monday, it's been, so a week and a half since brokers have hit the ground running. All right, now we've got to sell these deals and get them marketed. I don't think anyone knows has a good idea, but we will know over the next couple of weeks. And the big question is, are there going to be enough deals for all the buyers?
Yeah, well, and that's what I've been thinking about just really this past week, and as I was kind of preparing for this, is the idea, in a couple weeks before, we were talking about all the buyers, all the investors that were coming in and really driving prices up, potentially making things more competitive. But it's not like sellers aren't going to come into the market too. They're going to see dollar signs just as much as investors see dollar signs. And that's going to be it. Really, the interesting thing is how that's going to pan out. Is there going to be so many opportunities out there that maybe the supply gets kind of pushed in investors' favor more than
Yeah.
I can't say investors' favor, but maybe it'll be slightly less competitive.
Well, it's a double-edged sword, right? Less price appreciation, that's good for buying, not as good for existing assets that you're owning. But I do think moderating is healthy for everybody. So if we're not in the double-digit annual rent growth or just growth in general range, if we're something a little bit more realistic, kind of back to where we were a couple of years ago, I think that would be healthy. And I think with interest rates rising and people seeing that inflation is certainly going to be high over the next year, 2 years, but maybe it's going to be moderating. Where there's a good chance of that. I think there's going to be less willingness to go so far out. Doubling what was already doubled last year, or even more than doubled. I mean, we saw a lot of asset prices go up, 40% easily, even more last year. So, but to your point, I do think there are going to be some sellers who are going to see that and be like, all right, sat on my hands last year, let's get this thing sold.
Yeah, so I'm very interested to see. It could swing a little bit either way, but I still think it's going to be very competitive.
Yeah, well, because I say, is there going to be a deal for every buyer? We're looking to buy, 10 deals this year.
Yeah,
so
exactly.
If everyone's looking for multiple deals, it may be a little more difficult. Matt, let's get right into the reports, though. So John Chang from Marcus & Millichap put a really, I think, pretty good video. Pretty straightforward, just looking at inflation risk exposure and comparing different commercial real estate asset classes, multifamily, self-storage, but also office, retail, hospitality, and just ranking, the risk due to inflation. And, we've been talking about this a lot, Matt, but it's no major surprise that, multifamily is one of really the best inflation hedges out there, especially in commercial real estate. The only two that they said, could beat out multifamily slightly are self-storage, because you're often resetting rents monthly, but then hospitality, where you are resetting your rates on a daily basis. So you're really able to track inflation.
Yeah, it is. So it is interesting that, I guess not quite so interesting that all of CRE really is a decent hedge against inflation. And that's what it kind of prefaces everything, is like, it's historically been a decent hedge against inflation. It can really kind of float above it. But yeah, multifamily, and it is determined, it seems like, by how quickly can you get a new rent at a new price that tracks inflation, rather than kind of being a victim and being a victim of circumstance and kind of trying to make up for past, maybe you've got a 5-year office lease and you're going in 2018 dollars and now it's 2022 and you're really struggling.
And they mentioned that on the video, saying that some office leases have inflation provisions, that will bump up, but many don't. A lot of your higher credit tenants they're not going to allow those provisions. So yeah, there's definitely a higher risk for some of those longer term leases for certain. And again, I think it's what is providing the opportunity because you have the ability to track inflation, as at the rate you're renewing leases.
Yeah.
But not every owner is on top of it.
That's true.
And that's what creates the inefficiencies. It's not like it's all being done automatically. And so what we're looking for are assets that, just the manager last year, they were just asleep at the wheel and kept rents the same, which we're seeing very much across the board, especially on lease renewals, where you're still seeing, anywhere from between kind of a 3 to 5% rental increase.
Yeah.
When rents have increased maybe 15% in that market. So let's say you go through a year or two of that, of 10%, total increase over 2 years, where the market's increased, 25 or 30%. So you've got a huge gap, and once that unit eventually becomes online, that's a major rent increase at that new rate, and that's where the entire market is.
Yeah.
And so finding those opportunities where, again, management is just asleep at the wheel, and sometimes even better, is, they've just started moving these leases.
Yeah.
Maybe they're not doing a lot on renewals, but the new market rents are significantly higher, and they've really proven out the thesis because they've achieved it. And so you can get 100. This is just an example of kind of what we're seeing. Okay,
Yeah.
so we know it's $150 more their new market rents compared to their average lease rents. Pretty confident that on the older average leases we can get them up.
And that's a really good insight into how you actually can take action and how you can really find opportunity in this situation. People talk about CRE as a hedge against inflation, as this kind of refuge against inflationary pressures. But if you're actually looking for opportunities here, you can really find a place that hasn't moved along with inflation, and you can use your own expertise and your own knowledge to bring that value up and make more profit.
Yeah.
So I thought that was interesting.
And it depends on where you are in your place in the investment, or the capital stack, and what your role is, whether you're a passive investor or an active investor. But I do think that active investors or passive investors partnering with active investors, there is a major advantage when we see these types of opportunities. But then also what you were saying is, by adding some value, really pushes the needle and can really accelerate it. So all of a sudden, not only are you getting that 100, there's 150 organic, but if you can get another 150 to 200 because of the renovation, you're bringing into a whole other class of asset. That's huge. And expenses are rising as well. There was a Jonathan Barr made a post on LinkedIn about saying that, and I think it was a really good point. And we'll tag him in this video, but so many people are talking about rent growth, but no one's talking about expense growth. And
like utilities,
everything. So, for example, payroll is going up, and it's going to continue to go up.
Very true.
Without a doubt, to retain the right talent. And there's nothing more important than who's actually on site managing the properties.
Well, and one of the things that I thought maybe was shaping some of the decisions that you're making in terms of the strategies that you're going after is those increased those increased prices, are those making you think twice about value add and maybe doing something a little bit more moderate than major?
Sometimes, absolutely. And it's more the uncertainty of can we get the materials? Can we get the appliances?
Okay.
That being said, it can be difficult, but you can usually get the stuff.
Yeah.
And maybe you're going to pay a little bit more for it. However, what we're finding is the amount that rents are increasing completely offset the expense growth. That being said, you still need to use the proper expense inflation assumptions, and if you are using the same kind of dollar per unit assumptions in your underwriting model that you were using in 2019 or even 2020, are using the wrong assumptions. Because, if you were assuming that payroll is going to be $1,000 per unit or $1,200 per unit, which was, somewhat typical, it's not going to be $1,000 per unit anymore. Just the salaries for community managers, leasing associates, not to mention maintenance staff. All this infrastructure work that's going on. It's hard to find, good maintenance supervisors, maintenance techs, especially since it's a very randomly skilled jack of all trades type position. But you said first, utilities. Across the board, we saw huge utility increases at the beginning of last year. I think on most of our properties it was a missed a budget. Looking at our budget variances, just because we just had a surprise, all right, utilities are going up. Now, again, you can offset that. At the same time, we were implementing utility bill-back programs, but sometimes, that's so you can only pass on some to residents. But rents are outpacing, but it's something to watch for, because if you're using a standard 2% inflation assumption, which was kind of the standard assumption for many years, and average, it probably will be, over the long-term average, 3% organic rent growth and 2%, average expense inflation. How convenient, obviously, it comes growing faster than expenses, which typically is. But if you're using 2% general expense inflation for 2022 and 2023, you better hope that your rent growth is overly conservative and you get more rent growth than you anticipated.
Yeah.
And you beat income, but you're going to miss on your expense budget.
Yeah. So basically, pay attention.
Pay attention.
Because maybe there are places where expenses haven't risen, and you can pursue that individual project. But if you're sitting on your hands, not raising rents, or moving forward with a planned value add that doesn't account for increased prices, then maybe you need to shift your plans.
Yeah. Bottom line, if you are assuming high organic rent growth due to inflation, if you got 10% organic rent growth plugged into your model for a year and you have 2% expense inflation, that doesn't make sense.
Okay. Yeah.
So if you're moderate on the organic rent growth, sure. But if you're saying, there's going to be so much inflation, but my expenses aren't going to see inflation, that's just, again,
you gotta
your
look
rent
at
growth you may be saved just because of how strong the market is.
Yeah.
And I think that'll probably be the case with most, but it's something to be, I would say, hyper aware of.
Yeah.
All right, let's just jump in. Marks and Millichap, again, GDP growth.
This is just a really quick overview of the strength of the economy at the end of 2021, at the beginning of 2022, and it sounds a theme that we're gonna talk about, and what we have talked about before. People are watching the Fed. People are thinking a lot about inflation, and a lot about what the reaction to inflation is going to be. This really is, though, aside from, yes, there are some things to worry about. There's a solid set of numbers supporting this growing economy. But again, at the end they close it out by saying it's not perfect. There's still room for growth. There's still 4 million jobs that are still not recouped from the beginning of the recession, and so there is a little bit of uncertainty too. So it's not like it's not perfect, but there is still a lot. Like, I think the good far outweighs the bad.
Yeah. Even
Even if you're thinking about inflation and interest rates, I think that there's so much right about this economy and so much to be optimistic about that I can't see a crash anytime soon. And I think that there's room to grow.
Yeah.
It's not like we're reaching some kind of bubble, because there's still a gap in employment, whether it's a labor shortage or whether it's 4 million jobs not recouped. There's still some jobs that are being left unfilled.
Yeah.
So
it's hard to see something that, given all the information we currently have present, what's gonna take things down. I mean, the only concrete example would obviously be the Fed moving too quickly, and I think but that's a universal risk. And actually, in the Marcus Millichap video, they stated on the onset, interest rate risk is universal throughout all CRE, and is kind of universal throughout most investment asset classes. So there's not, outside of, maybe, I don't know, I'm not sure which asset class is the best to go into outside of financials, maybe, in an rising rate environment to protect yourself from interest rates, being short bonds, could be an option. But again, you're being much more, tactical. It is really interesting, and this is, I'm going to get into this in a second here, about how inflation seems to be the top line concern for most Americans, and I agree, that's what they're experiencing. But when it comes to investments, people are less concerned about that than they are about the reaction to it, or at least the causal chain is a lot more impactful
to investors. There's a direct impact when it comes to raising rates, right? And inflation is kind of ancillary, and then it's like, well, if the economy goes down and everyone goes down, it's still a bad thing.
Overheat too much.
Yeah.
But then there's probably black swans out there. I mean, there's whole Russia, Ukraine, and the U.S. and NATO. Again, that's I'm thinking about that. Could that, set the, like, let's say there's a full-on ground war in Europe, which I think is a hyper low probability event. You could send the global economy into recession potentially, if, all of a sudden energy prices spike, Europe's cut off from gas, there's just uncertainty in general. But tell me how that really affects, someone renting an apartment. Other than the economy goes down and
that's
there's
farther,
layoffs,
it's still a farther chain. Yeah,
it's a very far downstream event.
Exactly. Yeah.
That is just it's such a low probability. It's not really worth worrying about. But are there other black swans out there we don't see? You have to assume there are a handful. But again, that's where I see a lot of commercial real estate sectors, specifically multifamily, being the best place. Because again, you're looking at other asset classes you can invest in to protect yourself from, insulate yourself from inflation, take advantage of it. The three that get spoken about the most, taking kind of tips out of it, but commodities, which have not performed very well over the last decade. They've been doing well in the last year or so.
Okay.
Just equities, the stock market typically does well in an inflationary period, but you're going to have to deal with the volatility, not is tax advantageous or efficient depending on how you're investing, but then real estate, and really it's commodities, real estate, and the public equities are kind of in that order. But what's unique about commercial real estate, multifamily in particular, is that beyond being able to mark to market every new leases. What's interesting about multifamily is that, unlike commodities, that really lagged over the last couple of years, and you're dealing with all these global inputs, things that you can't control. Russia decides to do something, China, OPEC, it's totally outside of your control, and it may not perform consistently. Maybe just get a couple of years of some really strong growth. Multifamily over the last decade has been an incredible performer. Real estate in general, but especially multifamily. And so it's an asset class that does really well in good times, is relatively insulated in recessions and down times, as was just witnessed during the coronavirus pandemic. Yeah. And then also in high inflationary periods, it does incredibly well. In the last 10 years that it did well, were relatively low inflation deflationary.
Yeah, that's and what I think is another that John Chang ends his video with. He says inflation is usually a short-term issue. Yep. And when you're getting commercial real estate, these it's a long-term investment. So yeah, I think there's reason to have some faith in the CRE economy, especially in this current environment.
Yep. All right, Matt. Report from JLL. Can the strongest economy in nearly 40 years keep CRE on track despite rising inflation rate increases? Sounds like we just gave an answer, but what does JLL have to say?
So I do want to, and again, the rest of this does cover similar things, but it does add a nice point of, I think, optimism. It says that in addition to the strong pace of overall economic growth, a few hopeful signs for the future emerged in the data. The composition of growth seems like it's starting to shift towards private inventories, and the portion of private investment which provided the greatest contribution to growth, as U.S. producers continue to rebuild inventories drawn down by strong consumer demand. There seems like there is some manufacturing, it's increasing, some inventories increasing, and some building that's being done. And we spent the last 2 years talking about supply chain reduction. I know that the announcements of Intel building a chip making facility, that's not going to go online till like 4 years in the future. But there is probably short-term decisions that are being made that will come online much quicker. And I bet that there was plans being made at the beginning of 2020 2021 to start build. Maybe they're going to build something here, and they saw the writing on the wall, it may be just this increased industrial activity too that's almost kind of coming to fruition, and a lot more things seem to be coming online and helping to alleviate the supply chain issues.
Yeah, are you concerned at all about that leading to a glut of goods or supplies at some point? I mean, that's the concern. I mean, there is a point. It's not like demand is not infinite.
Yeah,
and so it's like you can build enough stuff, and if everyone is like sees green lights on build, make.
Yeah, that's true. And I think that it is something that's worth keeping an eye on. But I also think that the demand seems to be still increasing and still present. And I haven't heard anything about demand increasing or demand decreasing.
I've heard it seems like it's leveling off a little bit. I mean, it's still increasing, but not at the same rate.
Yeah,
which again I think is probably a good thing.
The story that I've heard is that these people are preparing for, and they're aiming for a point in the future where demand is still going to be high and they're still going to meet it. But
that's the concern, is that we assume, we've talked about this a lot of times, is that when you're making these projections and you just assume the demand is going to remain constant when it's been an anomalous amount of demand. We can't, this isn't going to keep going on forever. Even COVID may still be with us, but we are already understanding that we have to just live with it and get back to work, and lockdowns don't work. I mean, there was just a big study out from Johns Hopkins University that said the lockdowns are absolutely ineffective. So we're not locking anything down again. If the Biden administration didn't lock things down during Omicron, I don't think it's not happening. There's no appetite for it.
And again, maybe I like being optimistic. I'm fine with being wrong and being optimistic. But what if, we make some investments in the logistics chain that change the calculation for the far future? So maybe we do, quote unquote, overbuild, and it would have been cheaper to have things made in another country, in China or somewhere, and have them shipped over. Maybe that was cheaper then, but now it's going to be a little bit cheaper to get it made in the factory that was just built. So it will be interesting to see what this is, how this may act as an investment and reorganize people's.
That's a really good point. It's just, again, comparing what the economy looked like and logistics and supply chains in 2019. What it looks like in 2022 in the next 5 years is going to be completely different. And it seemed to be cheaper maybe to build in China or wherever, but now if you take in the risk of not getting your stuff and those bottlenecks, that risk, once it's factored in, it becomes not as cheap necessarily in all cases. I think in many cases it still will be, but it's a good point to just not be looking through the same lens as we have been over the last couple of years.
So I'd like to be optimistic, and I don't think that, and we'll see numbers for the industrial growth. People still building multifamily above all.
So Matt, let's just briefly talk about the stock market. We saw a lot of volatility, especially last week. A lot of the indices were in correction territory, although, as we had mentioned, a lot of this was anticipated. And there's a lot of kind of reshuffling. And there's been some earnings this week that have come out. Apple's done really well. A lot of the big mega tech has done really well with earnings. I think Google, Alphabet just announced, a crazy stock split they're getting ready to do. So part of me is like, is this just, kind of the major movers in the market, bringing the market down so they can reposition, their own positions at better bases. But it is what it is. And we saw a lot of volatility. Things don't seem like they are going to continue to crash and kind of keep moving upward, although we don't know. We don't focus on the equities markets. But what does Market Watch say? What's the good takeaway?
So and as we have highlighted, it really is uncertainty. We've talked about inflation a lot. It's not necessarily that I'm getting sick of talking about it. It's just it's just a fact of life. I was curious. We've talked about it so much, and people always are talking. 2018. I looked up a 2018 article that has "Sparking Inflation Fears" in its title, and they're afraid of a 0.5 increase in the CPI, which I thought was quaint.
Yeah.
And the top article on Google News last night was "Inflation is real. Buy real estate." we're past sparking fears right now, and now we're in this uncertain era where it seems like every eye blink, every breath that Jay Powell takes is it could lead to a sell off or a real bull market or whatever.
100%. Matt, do you ever think that it's not you think, I know so it's like on your Google News feed, it's like how much are they just feeding you articles that they know you're gonna read, and how much,
that's
so like,
true.
Do you think everybody got that article?
I don't know. That's true. They probably algorithms.
I'm just busy. Like this guy, this guy is reading a lot about real estate.
Yeah,
and he's reading a lot about inflation. Let's dish him up this article. but sometimes you almost want to log out and go in incognito mode or whatever to see if you can. Although I always still wonder about your IP address.
Yeah.
Anyway,
I do want to say, and I mentioned this before about how there's kind of a causal chain, and you can interrupt me here if I'm heading off base. But let's say, and this is like the concern that I'm trying to kind of speculate about it for CRE owners or for multifamily operators. So inflation goes up, and then maybe multifamily rents go up, and there's also more investment in multifamily because it's historically a hedge against inflation. It's good so far. But then this third part, which is, I think, worse for multifamily investors, is that there's some centralized efforts to reduce inflation, like the highly watched movements from the Fed. Mm-hmm. Now, we've mentioned that runaway inflation has this like abstract concept, and it has it's a little bit farther removed from interest rates. But if interest rates go up, that means multifamily yields go down. That means a drag on profit margins a little bit. And I'm not predicting an inflation-related economic collapse because because that's going to be the least of my worries.
Yeah.
But what I am worried about a little bit is that the reaction to the inflation by the Fed is going to be a determining factor for some multifamily investors. It's going to mean that some deals won't pencil out, and if the Fed makes some more aggressive moves, and it's going to mean maybe there might be less activity in the multifamily market in general. So that seems to be the determining reactor and the determining factor to some of the volatility. It's not necessarily these traders are swinging up and down because of the uncertainty over inflation. It's the uncertainty over the reaction to inflation.
Yeah,
that's really the big factor here.
That's a really good point. I think that there's a good chance. I think you're right, Matt. That is it going to throw a little bit of cold water, on the markets in general,
Mm-hmm.
of being like, okay, maybe we're not going to see insane growth because finally there is a moderating force. I mean, as of today, the Federal Reserve is still providing liquidity in terms of buying, mortgage-backed securities and treasuries.
Yeah.
And that's going to stop in March, I believe.
Mm-hmm.
But, we're going to shift from a overly accommodating environment to a, more hawkish environment, trying to, pump the brakes. But again, I think it's more trying to pump the brakes and slowing things down a little bit.
Yeah.
Because what I don't think is fully trickled in is the wage increases.
Yeah.
I think we're still going to see that over the next year or two, and that's going to be kind of buoying higher growth throughout the economy. And I think the Federal Reserve sees that, and they want to start pumping the brakes. I think it'll probably temper most markets. But again, if rates increase, it definitely does decrease yields. But again, on the other side, if it's in response to inflation really rising because you're seeing wages move up and rents are going to outpace. So your debt service, maybe a little bit more than it was a year or two ago, but your income is so much higher.
Passed on. Yeah.
What is concerning is, and this is what you hear the Fed talking about, and they were kind of on damage control the past week or so, is saying that, because they're saying, sure, we could do a 50 basis point Fed funds rate increase if we wanted to, but we probably won't. Mm-hmm. And we're going to be very quick to see that if it's too much, we'll, take our foot off the brakes and maybe not put it back on the gas, but just, let us coast a little bit.
Yeah.
But if they increase rates significantly, but then we don't see the growth for a variety of reasons, we just don't, the growth just slows down. Mm-hmm. That's when things could go bad, because we had all these people, like we were just talking about, in every part of the economy with these huge growth projections. People are planning on producing more, raising rates, and people have made investments based on this higher growth in future years. But if you don't get that growth, but your debt has gone up, that's a big recipe for disaster, because now you have to refinance, you have to sell because you have a shorter term loan. You can't.
Yeah.
That's how people can get in trouble. Now, what's going to cause that quick reduction in growth? Well, it could be raising interest rates, and that would show that we're in a completely artificial economy. I think we're in a partially artificial economy. There's real demand out there, but the Federal Reserve has definitely been.
Yeah, and that's what that's what we kind of talked about it a week or two ago, is that there's that layer of froth in the economy, and there's maybe a layer of vulnerability. Yeah. But then I think there is still room to grow, and it is worth mentioning that. So rising interest rates would have a direct effect on the investment market and on businesses and business plans, but it's inflation that has the direct effect on everyday person, and having to weigh the balance of those things is probably why Jay Powell measures his words. Basically.
Yeah, well, as I heard on, I believe, Bloomberg, or I don't know, seeing one of the big national finance outlets. It's a surprise that one of the mandates of the Federal Reserve isn't to prop up everyone's retirement 401k or the real estate market. Or the stock market. That's not the goal of the Federal Reserve.
That's true.
It's stable prices and maximize employment. Hitting it to the moon is not on the list. So So don't expect that. But at the same time, you always have to wonder, because they are obviously watching markets and sentiment. And they're very sensitive to know that they have an outsized influence on at least the public markets itself that are forward-looking markets. Okay, National Association of Realtors put out this is their 2022 report, Matt.
So
real estate
this
overview.
And we're done with the forecasts. I said that last week, and now we're on to. It's been 22. It's been 2022. There's been a whole month that's gone by, and so we're getting these monthly reports again, and we're beginning to get a good picture of what the year is going to look like based on what has happened in the year. And this, I like to read the NAR report because it does have this comparison against all the different markets, and you can kind of measure and see how the office or industrial or retail hospitality is doing compared to multifamily. This report does talk about the economic situation and how job growth is a huge part of this. More jobs, higher wages, that drives higher rents. And this NAR report has some relevant information in this regard. And on this page, if you scroll down just a little bit, they have a list of the highest net job gains. And so there are the usual suspects, I guess. Salt Lake City, Utah, and Tampa. We've seen them in strong multifamily markets, and they're just strong markets in general. And they're also leading in terms of job gains. But it's also worth pointing to Indianapolis and Kansas City here as Midwestern markets with very strong job growth themselves.
One thing to note, Matt, that on this list, I've had to call out Salt Lake City because it also, this is in reference to resilience in downturns. Salt Lake City had the least amount of job losses in 2020 during the pandemic. It actually may have had some very slight gains. I think it was just the least amount of job losses. Indianapolis was number 2 or 4 in the top 5 in the country for least amount of job losses, where almost every other market saw massive job losses. Even your Tampa, Floridas, and a lot of these, the Atlantas, a lot of these markets that have seen big job gains had big losses. Where Indianapolis really didn't lose that much and now has seen decent gains. But Salt Lake City, they did not lose hardly anything in the pandemic, and now they're on the top of the list. And if you hear a lot of housing experts, they will say that a KPI to look at more so even than population growth is employment growth and job growth.
Interesting.
Because people follow the jobs.
The
jobs don't follow the people necessarily. I mean, they can, but it's more likely there's openings. People are going to travel to those locations and markets for those opportunities.
That's very interesting.
Yeah.
And so it also has a great monthly comparison, again, this NAR report, of comparative vacancies. And and when it comes to vacancies, it's interesting that we see fairly similar numbers across the different sectors. So we're seeing about in the fours, 4.8, 4.2, 4.6, and that's for multifamily, industrial, and retail sectors, respectively. And the outlier here is the office market, which is around 12% vacancy. Even though there's these similar vacancies, and multifamily is higher vacancy than industrial and retail, multifamily investment is just taken off in a way that those haven't. Really interesting.
I would say industrial has taken off, and
Well,
without a doubt.
Yeah,
it
that's true.
outperformed
Yeah.
cap rate compression and
now
investment.
another thing that's interesting in the following page, it talks about construction, and the highest construction numbers belong to multifamily. And we're talking about units under construction as of 2021 fourth quarter.
This is square feet as a percentage of inventory, I believe.
Yeah. So, or I'm sorry. So the amount, this is a rough estimate. It's not necessarily units under construction. But 3.8% of percentage of inventory is under construction for multifamily, and compare that to industrial, 2.9% is
That's
under
pretty high.
construction.
It's still relatively high.
Oh yeah,
I mean,
both of them are
obviously
high,
multifamily is
but it is, it's
and
about a
this-
third more.
And you
for
see this
multifamily.
uptick.
Yeah.
That's the big difference. Where multifamily has actually declined a little bit.
Yeah.
Over the last couple of years, we had built, up to 4%. Now we're slightly below 3.8, whereas industrial was sub 2 for the longest time, and then we've seen in 2020, again, a lot of this is e-commerce and logistics related, jumping up to basically 3% of total inventory. So I think that is interesting to watch, but retail has declined over the years, and office has begun to decline.
Yeah. So that was basically the most interesting insights that I got from this NAR report. It did talk about how, we've got 11.3 rent growth that they measured for 2021 in the multifamily industry.
Yeah.
And that lines up with a lot of similar reports that we've had too, but it's a good also number to track as well.
Absolutely, Matt. So let's very quickly touch on just the NMHC quarterly survey.
Yes.
And then if we have time, maybe the apartment list. The only thing, and again, as you can tell, there's more reports that come out than there is time to even go over. And this is going to be, probably, an hour long just breakdown and analysis. The one thing about the apartment list article that I thought was worth mentioning before we get into the NMHC survey is the discrepancy in net rent growth, year-over-year rent growth on the apartment list metrics compared to everyone else. And you've done these comparisons, Matt, in the past, but they had, I think, 17% year-over-year rent growth.
It's a big outlier.
And then most of the others I've seen now are like, and this is, I think, including January, I believe, and so most of the others are like in the 10, 11%. Now, apartment lists, which again you've known in the past, sometimes their rent growth, it can be a little bit higher than others.
Yeah.
I'm curious, just what the discrepancies are.
I wonder if it, part of it's probably how they measure it, obviously, but also maybe they are taking account a greater number of markets and submarkets, or maybe a different unit type, or
it could be a different mix of
or something. But it is, the effect is the same. The apartment list numbers are always generally going to be higher when, at least lately, as far as we've covered it, they are measuring stronger rent growth. Now, one thing I did want to note here is that line graph that you see. So that's a little bit. You can see this maturing trend of stability in the multifamily market. You could see it soaring skyward, in the last year. But since really October of last year, it's plateaued a little bit.
Yeah.
Not really cooling off, not rising significantly, but definitely not getting lower. Year-over-year rent growth in January was 2.3% in the 3 years preceding the pandemic. So it's not like we're doing badly.
Yeah, well, and this is a rate of growth. Also, it's not like there's been it's the rate of growth has stabilized.
Yeah,
and I think it's also worth pointing out that it's very typical and is to be expected. Just seasonal changes. This is kind of the end of leasing season. School starts.
Yeah, exactly.
And so in the past couple of years, you always see a decline in rent growth, after kind of this peak leasing season here, really from, call it March really through October.
Now, one more thing I wanted to note is if you scroll down the quick map that they have, and I always I was like looking at their map of the markets.
Not this thing.
Not the graph. So obviously you can see the Sun Belt as this area really at a glance. They have these markets represented with dark orange for strong rent growth, and along the Sun Belt, along the southern United States, that's where the strongest rent growth is. You can see this visually represented, but you can also see a little ribbon cutting through Indianapolis and upward towards Michigan as this area of strong Midwestern rent growth that is not necessarily anomalous in terms of Midwestern markets, but it is an area that has some kind of regional appeal, and I think it's just an interesting thing that you can see kind of at a glance when you're looking at the map.
Knoxville, 33% rent growth. That's just incredible. Louisville, Kentucky, only 8.5%, still not bad. But Houston, which is an incredibly popular market, only 7% rent growth. That's interesting. They've got some suburbs maybe doing a little bit better. 13%. Austin obviously is that's Dallas. There we go.
There's these desert markets that are.
You mean like actual desert markets, like in or they're out on their own?
They're both. It's like metaphorical heat and high
Las Vegas,
temperatures.
Tucson.
That's where people are going.
There's been some controversy in Tucson. A handful of investment firms have come in, especially some from Canada, I guess. And I followed this one because I have a family in Tucson, but there was a big uproar about an investor coming in and buying a senior living facility and raising rents by 40%.
Oh,
and it did not come. People did not sit well with people. And then just again, now there's stories of people saying they're forcing vacancy by basically telling everyone to move out so they can renovate the property. But you look at it, and you see 30% rent growth. You can see how that could be happening. Now, I think there's better ways probably to deal with some of your long-term residents and goodwill. But when there's such an incredible opportunity, I understand how those business plans are put together. So, but again, Florida, I would say if there's one state, well, it's hard not to throw Arizona. There's less markets, but Florida definitely seeing the most. Was that a burnt orange, Matt, or red? I don't know.
Yeah. It is definitely the dark orange, the highest indicated rent growth in that area.
Okay, let's get up to let's talk about this Nmhc survey, and there'll be the last report, the Berkadia Power Poll. You're gonna have to go to grayreport.com to find all this stuff because we don't have time to cover everything.
Yeah, we
gotta find wait
deals. For the newsletter for the Powerhouse Poll.
Wait for the newsletter, either grayreport.com or make sure you sign up for the Gray Report newsletter, graycapitalllc.com/newsletter. You can also find the sign up at grayreport.com. Okay, NMHC, National Multifamily Housing Council. They're surveying, owners, people in the industry. First question. How are apartment market conditions in the local markets that you watch? Tight markets are defined as those with low vacancies and high rent increases. Conditions obviously vary greatly from place to place, but on balance, apartment market conditions in your market today are. So it's not how hard it is to get a deal, it's how low vacancy is and how much growth there is. So in going back slightly to July 2021, tighter than 3 months ago, 92% of people, just July, so it's 6 months ago, said, it's much tighter than 3 months ago. Now, today in January, it's only about half people are saying that it's tighter, and that makes sense. As again, we talked about the seasonality.
Yeah.
Back in July, rents had just moved by like 10%. It seems like in a couple months. So it's like this was huge change. No one. Very few people are saying it's really looser. Just some people are saying that it's. Well, I guess 40% are saying about unchanged from 3 months ago. People who don't know, hardly anybody. Everyone has an opinion, it seems. But what about sales? of apartment properties in the local markets that you watch. The sales volume, number of deals currently is higher. 40% people in January say is a higher amount of deals on the market than they saw 3 months ago. But back in July, it was 60%. And that makes sense to me for a couple of reasons. One, do we know when exactly this survey was taken? Well, assuming that it was taken prior to like a week, like it wasn't taken this week. It was taken prior to the NMHC meeting. Again, as we talked about earlier, so many of the deals don't roll out until after NMHC meeting. And so, I mean, the NMHC meeting was at the end of January. Now the deals are rolling out. So a lot of the deals had dried up. Everyone trying to get deals done before the end of the year. So usually being January, there's lower supply. So it makes sense. Now, July of last year, though, it makes also a lot of sense because we didn't have an NMHC in January. In 2021, it got booted to, surprise, surprise, July in San Diego. So that's when a lot of the deals were delayed in rolling out. So I think this makes
well, and it's sense. Also worth, it's the combination of higher and unchanged is 75%. So that's not a bad number either. It's greater than or equal to 75%. It's pretty stable. But I think that if we're going, pre-pandemic, I don't know how that would compare.
But what I know is that the February survey is going to be vastly different. I think we'll see people say 60. It's going to go back 60%. People saying that it is higher.
Yeah.
Okay. How about money? Equity financing for apartment acquisitions or development. Considering both price and non-price terms, equity financing today is only 35% of people saying that it is more available. More people are saying, more people thought that more money was available in July compared to 3 months ago. Not saying that there's more, they're just saying it's even more than 3 months ago. Vast majority of people in January are saying it's about unchanged, 60%.
Yeah.
There's a lot of money. There's still a lot of money, is what people are saying. How about debt? Is now a better time to borrow? This, I think, is the biggest change that we've seen. Only 8% of respondents said that now is a better time to borrow than 3 months ago. Now, back in July of 2021, it was 45% of people saying, yeah, it's better time to borrow than it was 3 months ago.
October, the rates were up too. You can see there, and I don't know if it was a Delta wave thing.
They had started to move, but back in July, the rates were still, you get some sub 3 debt. And we just closed on a, sub 3 mortgage 2 weeks ago, but it's definitely a rising rate environment. People are anticipating that, pricing that in. And again, I think what maybe the most important thing, coming back to our conversation at the beginning of this video, talking about, how bullish are buyers going to be, how willing are they going to be to go out there with rising interest rates? It's a good question. Certainly this survey says people are tamping down expectations, at least for debt financing. Okay, talking about rent control. Question number 5. An increasing number of jurisdictions have recently either imposed or strengthened rent control limitations or are seriously considering doing so. Don't consider it. We would like to know whether this has affected your investment or development decisions. 26% of people, that's a decent amount, quarter, have cut back on investments or developments in these markets. Welcome to the club. Only 15% of people say there are no changes. 23% that there's no change. 15% are saying we have not made any changes yet, but we are considering, so they're concerned about it. So that's almost 40% of respondents saying they're like, I'm kind of concerned about rent control.
Yeah. I'm kind of taking these with a grain of salt. I feel like if they weren't in those markets now, they're not going to jump into them. And if they are in those markets, then maybe they do know how to deal with them, because there might be a way to operate profitably in markets with rent control. And also, there are some people that are pro rent control, and they say, fine rent control, but let's reduce the regulations and make it easier to build more houses. That's really what's going to happen. Rent control is It stinks for the owner of that specific building, but you can have a huge effect for investors and for people that want to live somewhere cheaply if you reduce regulation. Rent control is not going to create or solve the housing problems that are that people are facing.
What is it good for then?
I'm not quite sure. For the people that live there, for someone that lives there, if someone lives there, and they are making X amount of dollars, and their wages aren't increasing, and they don't want their rent to go up, I understand that, but it's not going to solve the housing problem.
It helps them, that resident, that day.
Exactly. It helps a very small percentage of people at the expense of the larger group of people.
But the unintended consequences over time is that even if you reduce some regulations, even though rent control is you're going to maybe reduce some development regulations, but you're going to drop in the biggest operating regulation you can really think of, rent control. You're going to see less investment. So probably not that much more supply, or not a significant increase in supply. The biggest regulatory hurdle to get over would be getting rid of the rent control.
Yeah.
The result over time is you're going to have higher rents down the road. So you're going to you have a very short-term benefit for a couple individuals, but the market as a whole is going to see higher housing costs over time. But it feels good because rent control, our proponents, because it feels good. Because to your point, you're like, I know that I'm going to be able to prevent this person from having to pay more rent, or this person from being evicted. Now, I don't care that in 3 years from now, everyone else is going to be paying over 30% of their take-home income to find a place to live, because we haven't built anything when we needed to.
Yeah, the only argument so this was someone that from the other side of the spectrum that we're talking about, but the only real way to make it work is if you pair it with even more aggressive deregulation and really zoning so that things are maybe more multifamily, so housing can get more dense.
But I guess my response to that would be, well, why don't you try that first?
Yeah, exactly.
What's the point of the rent control? If you're going to solve the problem, you don't necessarily need the superficial feel good solution.
It helps a small group of people a lot in exchange for a loss of opportunity for a much larger group of people.
And I would even argue that how it really affects that many people that much, even individually. I think certainly there's going to be some cases you can point to of people saying, "Oh, my market is now rent controlled, and I didn't get a big rent increase." You don't know if you were going to get a rent increase or not. But the amount of unintended consequences and the downsides, I think, far outweigh the risks. And just about all economists are on the same page with that. It's just the politicians out there and the people who are maybe new to the housing market and housing economics, who again are going from much more of a political win and a feel-good position, rather than how do we provide more housing so housing is affordable. All right, we are going to miss the Berkadia Powerhouse poll and the RealPage multifamily permits, a report from RealPage describing how permits have jumped in January, which we touched on earlier, so it's okay. But if you would like to get access to all these reports sent to your inbox on a weekly basis every Thursday morning, 8:30 Eastern Standard Time, the Gray Report newsletter, you can sign up graycapitalllc.com or grayreport.com. There's a little sign-up thing there. And again, grayreport.com, we're aggregating all of this information. If you don't want to wait for the newsletter, you want to see what's going on, latest, again, research reports, articles, analysis. We've got market updates. We're tracking the largest REITs, cryptocurrencies, public equity markets, podcasts, videos, everything in one spot. So if you are quasi-interested in the housing industry, Gray Report should be one of those bookmarks. And if you're not signed up for the Gray Report newsletter, then you're missing out, to say the least. Matt, this is a great report.
Thank you.
A lot of good stuff that came out. And again, I think it just helps us paint a good picture as close as we can, adding some color to what's going on, and it adds some data points to the world around us so we can try to make some informed decisions. But, as we've said in the past, and many smarter people than us have said, it's not about the quantity of information, it's about the quality, and it's about what you do with that information and breaking it down.
Yep.
And one thing that you've done a really great job at, and it's been really interesting, is not just looking at, here's a report, their report, but comparing these different sources
Yeah.
and comparing the data, seeing the discrepancies, why those are, just like we were talking about the
And
apartment list. And
if you want to go on the Gray Report blog, I do have a running total, a running average of these forecasts, and that's one of the things I'm working on this year is coming up with a nice decent average of what people can expect.
Yeah, I think that'll be really good. I think you just described almost like a 538, a real clear
Yeah,
politics
that's
kind of
right.
average of all the averages.
Yeah.
But that's often a good way to really look at it.
Yeah.
So be watching out for that. And again, if you're looking at making some allocations to multifamily real estate in 2022, and you're an accredited investor, we'd love to have a conversation with you at Gray Capital, graycapitalllc.com. Like we've mentioned, we're launching the Gray Fund. We're going to go out and buy about 7 to 10 large multifamily assets, mostly in the Midwest, cash flowing. We've got a great pipeline right now. Putting together the team. We're building partners. We've got a lot of people writing big checks, but we've got some people that are writing not as big of checks, and we're equally as excited to have them on board. So get in touch with an investment associate here at Gray Capital. Walk you through. Again, only open to accredited investors. None of this is investment advice, all for education and good times. See you next week.